Thank you so much, Hans. So thank you, everyone, for joining this webinar today. And my name is Caroline Milne. I am Director of Marketing and Communications at Joule Assets Europe. And today I'll be speaking, my presentation is called Bridging the Gap from EU Project to Market Enabler, Creating the Marketplace for Sustainable Energy Assets. And I will be looking to give a practical presentation really discussing my company Joule Assets experience taking an EU project and bringing it to market, commercializing it, and discussing the experience that we've had. So I'll get started right away with the agenda. So first of all, I'll give a quick overview of who we are, Joule Assets, speak about the EU project itself, what was it, why did we do this, a bit of information on the consortium, then the actual result of the project itself, which was a platform which is called eQuad, which I will explain in more detail shortly. We'll look at a few case studies, lessons learned, and then conclusions, the way forward, what we see is needed for continued market development. And then, of course, happy to answer all of your, as many questions as possible. So a bit of background about Joule Assets first. Who are we? So we started as a financial fund in 2010 in New York, dedicated to financing small energy efficiency and demand side projects, projects generally well under 1 million. Our CEO, Mike Gordon, I think was one of the few people in the market at that time who was acutely aware that there was the majority of the market, at least in the US, for energy efficiency was smaller projects, and that these projects weren't being financed. And so the fund was really dedicated to launching projects and connecting the dots. And essentially what happened was he eventually thought, let's build a pipeline in Europe as well. And it was quickly obvious that there was actually a lot of finance already available in Europe. But the question, and also starting a fund is a very big undertaking. So the question was really not let's create a new fund, but why is there a gap? Why is the money not actually, why is it sitting on the table? Why are there so many potential projects, and why aren't they being done? Why aren't they getting financed and reaching completion? And so this is really how we started. And we got a grant for the Sustainable Energy Asset Framework project, which was H2020 funded. This launched in 2016. And this is really how we began in Europe. In the States today, we don't have a fund anymore. We've gone on to do many other things. We've launched an ESCO actually called Joule Smart, and our most current activity now is leading the community energy movement in New York State. And I'm also happy to speak about that if you have any questions, but that won't be the focus of today's presentation. So just to sum up, really, who we are as a company is, in Europe, we are really looking to be the marketplace for energy, sustainable energy assets. So that really covers all energy efficiency projects, especially the smaller SME size one. That's really our focus, as well as these energy efficiency projects that also integrate renewables. We really see that as the future. We see that as there's a great potential, and not only that, but there's a very, very real need to get finance for these projects. And it's not something, the battle hasn't been won yet. There's a lot of work to do. So we look to engage at many levels with associations in various countries. We're involved in other research projects as well. And you can also expect more logos and things to pop up on these slides in the coming months as we have more projects and activities coming. So SEAF, again, the Sustainable Energy Asset Framework, it was an H2020 funded project. It was 1.7 billion euros and 2.5 years, just about, so 28 months. It ran from February 2016 until May 2018. You can see the project partners. We had Joule Assets, the Aristotle University of Thessaloniki, which was really our technical partner, which I'll explain momentarily. The University of Manchester, who provided some research and future energy modeling. HSB Engineering Insurance. Verco, who is a quality assurance provider for the Investor Confidence Project, which is a form of standardization of energy efficiency projects in Europe, and SEA, who is an Italian ESCO. So what we actually did with this, the aim of the project was to create a platform. It was precisely to create an online platform where investors in energy efficiency projects and project developers, so I'll use the term contractor, but I'm using that quite broadly. It generally covers ESCOs, engineering companies, and project owners, developers in general. We usually work with ESCOs, but I'll say contractors. So we have contractors on the one hand, investors on the other. And the point of this platform is to essentially create a common language for the two players to meet in the middle and to make a deal faster than they would otherwise. One of the common problems that we saw with ESCOs, at the very least, was that contractors, oftentimes there was a lack of knowledge of finance that was available, and then a lack of knowledge of how to present a project to a financier and how to get that project over the line. Financiers, on the other hand, were finding that there was a lack of standardization of projects, how they were presented. There was a lack of trust in whether the performance of the project would actually hold up. So what our platform actually does, and what we developed, which was basically the University of Thessaloniki helped us put this platform together, was we took Joule's financial valuations that we developed as a financial fund in New York to evaluate projects and develop a standardized pro forma that has been designed for investors. Then the standardization, the contract development, we also support with the ESCO's actual contract with their end client, together with the investor very often. Then there's the standardization element, which is where ICP, the Investor Confidence Project, comes into play, where they have developed technical due diligence for projects themselves. And then the insurance quotation, which is where HSB Engineering Insurance comes in. So they cover against the shortfall in savings for a project, which can also increase the confidence of the investor. And then at the very end of the road is the investor, project, and contractor handshake. So the idea, as you can see, is really to simplify as much as possible the entire process to getting finance. The results for investors are exactly, I'll go through this quite quickly, but essentially we look to provide projects to investors that actually match their requirements. That's probably the most crucial element. We discussed with investors during SEAF about 20 different financial funds, and they all told us that about 80 to 90% of projects they receive actually don't make it to finance. So their processing fees and the due diligence fees that they go through, their upfront costs are enormous, and they have a lot of lost time going through in projects very thoroughly, only then not to be able to invest in them because it turns out that there's something that doesn't match and there's something that doesn't add up for them. So this is a very big thing on the fund side. Again, the due diligence and the insurance, this isn't actually a requirement for many funds, but especially for funds that are quite new to the energy efficiency sphere, this really helps build trust and ultimately the project. So it can be challenging and time-consuming to develop your actual pipeline portfolio, and so eQuad very much supports with that. What we've seen and what we saw at the very beginning for ESCOs was that, as I say here, the key to growth isn't just technical, it is contractual. ESCOs require a certain innovation in deal structure, which generally isn't there, and that which eQuad was intended to support with. So for example, one key thing that we always look to do is help, together with the ESCO and the investor, develop umbrella contracts that would bundle many small projects that are with equal capabilities, that are using the same types of technologies into one contract, so that which ultimately then minimizes the time that is spent on each single project, and it gets things off the ground faster. Speed is a clear issue in this sector, which we're looking to solve. Risk mitigation strategies, again, which fit with their own projects and their profile. A couple other things I would say would be EPC contracts, off-balance sheet and performance-based. This is what a lot of ESCOs we know are looking for, and oftentimes they struggle to find investors who have capabilities to work with these types of contracts. And specifically when it comes to off-balance sheet, so we look to as much as possible work with funds that are able to create SPVs rather than doing straight debt, which is then added onto the contractor's balance sheet and burdens them, which burdens their balance sheet and impedes their growth. Investor requirements in general, we can look at these, and I can look at these in slightly more detail, but overall what we've seen that with their requirements are creditworthiness of the end client is very important, as is a strong project pipeline to pay for upfront engagement. If it's a one-off, very large project, then that can be fine. But when it's a very small, if it's just a 50,000 euro project with an SME or a 20,000 euro project, the contractor needs to demonstrate that he has a pipeline of projects available. The creditworthiness of the ESCO is equally important. Low payback time for projects is often the case, but not always. And of course, we do want to get away from that as we're seeing needs for deep retrofits. However, the reality of the financing market that we've seen is that they're still looking for quick returns. Of course, robustness of the project design and the project investment should be part of the ESCO's core growth strategy. This is actually quite very key here. So eQuad launched, the actual platform launched in May 2018. So we've been operating this now from Joule Assets commercially for close to a year. So which brings us to where are we today? As you can see, this is just a quick glance at our pipeline early on. This was a few months, I would say, about maybe a quarter, 2 quarters into after launching eQuad commercially. So you can see we are mainly in a few markets at the moment, in Ireland, the UK, Italy, and we actually had quite a few projects in Greece. The total pipeline was 164,000 euros. I believe this number has changed a little bit in the very last month. I haven't had a chance to update this slide for a bit, but we've had some projects that have been financed and others that have recently come in. So these numbers have changed slightly, but this gives you a very good idea of how things have been since we've started off, and this is just the beginning. So about 45 projects across 4 sectors. So industrial sector was definitely quite huge, actually, followed by tertiary, like commercial, a few, maybe 1 or 2 residential projects, and then some projects that are in the agricultural sector as well. You see the average IRR was 11 to 18%, which is quite good, and this is generally in the range that investors would be expecting, with an average payback time between all projects of about 5 years. However, I should be upfront and say that these numbers are maybe a little bit distorted because we had 1 or 2 very, very large projects while the rest were quite small. So take this with a grain of salt. And you can see the main technologies. It's pretty much just about everything across energy efficiency, we have yet to cover deep renovation, although we would be very happy to support here as well, as we see there's a great need. So one question that we're very often asked is, what actually is the finance for energy efficiency projects? We do have an investor network, and yeah, these are the questions that I'm asked the most frequently, is what is actually available? Because the problem is that you can't have a platform that does all these wonderful things, but then have financiers and different funds whose requirements don't actually meet the reality of the market. So we have discovered some difficulties since starting off, since launching commercially, which I'll get into. But the good news is that there is really finance available for energy efficiency, and there may not be one perfect solution depending on the project or the contractor, but most likely it's possible to make something work, and there has to be some negotiation and some, I think, give between both parties very early on. So let's look at, I'll go through quickly some of the financing options. I'll explain them in some detail, but I don't want to bore you too much either, because I'm cognizant that this webinar isn't just about finance. So the main finance that we have now within our network, which is ready to deploy, would be bridge finance, full equity, a couple ethical banks, and factoring. Now, these are all particularly interesting for contractors who want to diversify their financing sources and have their projects or a part of their pipeline off balance sheet. As I'll show in the following slides, all of these structures involve the creation of a special purpose vehicle, or an SPV, which takes on the finance burden instead of the contractor, which is very interesting. So I'll give you a brief description of each, show you what type of projects, clients, and contractual structures fit these financing structures. So the first one is bridge capital. So in this case, we have an investor who offers around 70 and 80% of the financing in the form of debt, who has two fundamental requirements. One, the ESCO has to participate in the investment, about 20 to 40% of the total investment, and also that there is a financial institution, which can also be a bank, that is willing to buy the project after 2 or 3 years. So again, here the ESCO is responsible for the installation, operation and maintenance, measurement and verification, and also for the creation of the SPV. So he takes on quite a lot of responsibility and really a leadership role here. As you can see on the right, the ESCO's balance sheet is totally free. They don't have any assets or liabilities added to their balance sheet. And that's because the whole project stays on the SPV balance sheet. So it's a separate company that is developed basically for the purpose of the project or group of projects. In some cases, especially for bridge financing and the ethical bank, the ESCO can or has to participate in the SPV, while in others, the investor is the only owner. So looking at bridge finance, the main difference from the other options that we'll go through is that this isn't a long-term stable loan. It's bridge capital, meaning it only covers the construction phase of the project. So what does that mean? It means that the investor will exit the project after a period of a couple years. It's usually around 2 or 3 years, but can also be as short as 6 months, depending on the timeline of the project. And after that, another investor then takes over and purchases part of the investor, the entire part that the first investor had. So the whole investment that the first investor made is purchased by another investor. So the initial cost of capital is quite high at the beginning. It can be around 7%, which sometimes looks like, for contractors, not very interesting. But ultimately, the next contractor, the risk will be much, much lower, because the performance risk is now completely gone. So the cost of capital can go down after quite quickly for, say, 4 years, which is interesting, or 4%, sorry, or 3%. And as I said, the self-financing part, between 20 to 40%, is always mandatory here. It's really because the investor wants to see that the contractor has skin in the game. I'm happy to answer a few questions about this after, but I'll carry on. And you'll receive the slides after, so you can take a quick look at the general criteria that is required for this type of finance. The next opportunity is full equity. So this basically means that the investor here creates the vehicle company and provides 100% of the equity of the project. So the ESCO here actually has a more marginal role, more of as an installer, and it's not part of the SPV, and so it doesn't receive the project's cash flows. So in that case, why would you choose full equity? Well, it depends on the contractual structure. So if it's an EPC with guaranteed savings, for example, the ESCO has the financing all off balance sheet, and in addition, it receives all the excess performance of the project. If it's EPC, there are other options with less risk. If there are other options with less risk, the investor has in this case an interest in investing in a very simple contract, such as an operational lease. However, this depends also on the technology. But for example, operational leasing is classic for rooftop PV, where panels are a guarantee and the payments are quite simple. So in any case, it's a good way to diversify the pipeline financing strategy of an ESCO and lighten its balance sheet if it's a little burdened, and especially if it's looking to do several projects and really build a reputation as a company that does very specific types of projects and offers the upfront finance. So it's very good for sales messages. And again, here are the main criteria. Happy to answer questions on that after, but I won't go through this right now. The next opportunity that we see readily available is working with an ethical bank. So here it's a form of debt, but the bank is aware of the balance sheet burden and will do this also in an SPV. It's different from other forms, so like factoring for full equity, in that it offers a cheaper cost of capital, say 2% even, but at the same time it asks for at least some buy-in. So the bank would provide 60 to 80% of the finance, and then the contractor would provide the rest. And again, you can see the key criteria here as well. Most of the technologies are all the same. Standard energy efficiency upgrades, PV, district heating, and CHP. This really covers all the forms of financing that we see. And just to go back to the ethical bank again, one of their key criteria here is that they need to meet, the end client at least needs to meet specific ESG criteria, so environmental, social, and governance criteria. And this is different depending on the bank itself. The last opportunity that we have here is factoring, also known as the sale of receivables. Here, the investor provides the finance for the whole project and creates the SPV himself. The difference from full equity is that yields are lower, but on the other hand, investment criteria are more restrictive and firm. Factoring is quite simple in itself. The ESCO installs, manages, and monitors, while the investor basically buys the project or pays the ESCO for the total investment, and in return buys all the future receivables of the project. In this, it differs from classic equity because it's more formal and a structured way to secure future cash flows. The project is always off balance sheet for the ESCO. It is paid in a first initial tranche for the construction, and then future receivables are purchased. And for an ESCO, there's the possibility of having off balance sheet projects that are replicable, and easy to implement. So again, this is very interesting for a company that is trying to, for example, they have a very cookie cutter type of project and a very specific market that they're looking to sell to. This would work very well because they can include the no upfront finance, no upfront costs as part of their key sales message and outreach to clients, which is often a burden, especially if you're looking at SMEs. So spending money in energy efficiency is usually never a priority. So for an ESCO to offer the fact that they can take care of the finance and they'll be paid back just by the performance of the project, it's a very interesting sales message. And so as you can see, some of the criteria here you can look at later in the slides. So I'd like to just get into a few case studies now to actually look at what's happened, some of the experience that we've had since kicking off. So the first one is a story of, I would call it a hybrid home. This project was in the UK for a housing association. It was looking to use different energy efficiency measures as well as CHP. I know there's boiler replacements as well. I don't have the list of technologies here, but pretty standard upgrades for energy efficiency, as well as adding PV on the roofs. There is the ability to carry out demand response. And what was interesting is that clients especially would have, the end users would have lower energy bills by about 10%, which was a big deal because these are low-income families. So that 10% could really go a long way for them. The total initial investment was £12,000, sorry, with a very strong IRR, a payback time of 7 to 9 years. And the energy service company had actually already piloted a couple homes on through their own on their own balance sheet. So they took the cost on themselves to pilot it to prove to the housing association it worked. So what was very nice about this project for most investors was that it was replicable and they had the ability to scale. So they weren't just looking at doing a few houses or one block. They would start with about, I believe it was 12,000, and then eventually scale up. But they would be able to scale up to 45 million. So there were several, I forget how many homes. It was about 500,000 homes, or 5,000 homes that they would be able to cover, which was very, very interesting. So what we looked at, this project, to be 100% honest, is still in negotiation. It's seen several investors, and all the investors saw that this project has come to have been very keen on it for numerous reasons. However, it's been slow because there are a couple issues that we faced which we didn't expect. So to be clear for this project, basically we went to funds that did bridge financing and an ethical bank. The ethical bank actually, both investors, I'll just say, had some issues regarding credit risk of the end client. I mentioned at the beginning that credit risk is always something that they would check. And so the initial question was, how would they deal with the fact that every energy user had, that there are so many different energy users, but they do a credit check on every single individual to pay their bills. And so this took quite a lot of time to resolve, and it was decided that the housing association was sufficiently, had sufficient liquidity that they would be able to take on the risk of the individual home renters or families. So if someone couldn't pay their bills, then the housing association would take that on, and the investor wouldn't have to go through 1,000 credit checks or hundreds of credit checks, which was already a very good start. And just as an aside, I would say that when people look at residential projects, this is one of the big issues, is scaling for investors and how to deal with the question of credit checks of so many individuals. Then the credit risk of the contractor, actually. So a minor technology supplier in the group was actually a very small company, and so the question really was, would they last? Would that company be around throughout the life of the project? Would they go under? So the project developer had to show that they had a plan, that they had another tech company who would be able to come in if for whatever reason their initial supplier had any issues. And then the risk of the technology itself. There could be a lot of technology risk for this type of project. What are your guarantees? And especially regarding the fact that there are so many different users, how do you know that they're going to be using the technology correctly or won't be destroying it? So performance insurance, for example, was one thing that was really able to support the case here towards investors for this project. So the bridge financing guys are still looking at this. The Ethical Bank, however, actually had to turn this project down, and they were very, very close to closing a deal. And the reason why they weren't able to say yes, they wanted to very much, but for them, the reputational risk was too great. Working with a housing association, if anything were to go wrong with this project, and this bank had their name behind it, behind the fact that, you know, there were hundreds of people living, benefiting from this housing association, and if their promise was broken, or if they couldn't, their utility bills weren't lowered, or if anything, it would be on the bank's reputation, and so they couldn't take that risk on themselves. For them, it was too much. So that's one thing that is, you know, really crucial to note. I have a few other conclusions written here. One, that hybrid homes like this do bring real societal benefits and returns, especially with today's prices. And the technology providers that we worked with really were focusing on the solution itself, as well as creating a very good offering to customers. And finally, the time and energy required securing investment shouldn't be underestimated. And this project took us by surprise because eQuad, we were able to do the financial modeling and get insurance and standardization for this project. But the realities of the investment world were much more complex. As I mentioned, there was no standard contract, for example, with housing associations. None of them had before dealt with the issue of having, you know, so many people in multiple dwellings. So this was a first for both the contractor as well as the investor. The next case study is lighting as a service. So this was a contractor that we've worked with in Belfast. This project has received finance. The deal has gone through, and it took less time. It still did take more time than expected. The story with this is that the contractor was initially more of a tech provider and installer of lighting, bespoke lighting services. And they had been doing that for a number of years. So they knew the technology very, very well. But they decided that in order to really reach especially the smaller, the SME markets, where there is a lot of opportunity and a real need to, and lots of gains to be made from energy efficiency, both financially and on the well-being comfort levels, they saw that switching to a lighting as a service, performance-based model would help enormously, whereby they proposed to the client just no upfront costs, simple contracts, simple installation, they maintain everything, they're good to go. So in order to do this, it's not so easy because you need to have the finance to have a strong sales message and to be able to take that message to the streets and go door to door to different potential customers. So they required a financial solution here. So we were very fortunate to work with them. They already were able to get a pipeline together. It was a modest pipeline of 370,000, and this was spread over 5 different quite small projects spanning the agricultural, industrial, and commercial sector. And within a very short amount of time of modeling these projects and having had standardized them, I think it was within less than 10 days, we had a finance offer from a fund of $5 million, and they were looking to do a full equity solution, as we saw earlier. This was in a way, it seemed very simple. The financing process at the outset was quite simple. The financier said, yes, we want to do this. So eQuad, as we intended it, worked very well. There was literally no problem with the pipeline. There was no problem with the contractor. They had $5 million that they wanted to spend in 1 year. They said, just spend it for us on lights. Just keep growing your pipeline. The problem was that the contracting phase ended up taking much longer than expected. It took over 5 months. Now, I should say that the apologies, I just lost my train of thought for a sec. I would say that the fund itself was brand new to this type of these type of projects. It had traditionally always done large, very large infrastructure projects, so easily 10 to 12 million and above. And taking 5 months to complete 3 agreements with an ESCO is unacceptable when you're looking to just do very small lighting projects with small, distracted end clients that are otherwise going to think of something else and lose interest. 5 months is completely normal, and it's a completely normal due diligence process for a large project, but it's not fit to purpose for this. And so we saw very quickly that the fund itself lacked experience. So the ESCO, results were that the ESCO lost a few of their clients at the outset and had to start almost from scratch to build their pipeline, which was very frustrating for them because they looked unprofessional for taking so long to deliver on what they promised, which was actually financing the projects themselves. And the next result was that the client was the client was confused itself. The fund definitely lost money on these lighting deals. They spent a lot on due diligence, on doing due diligence the way they always traditionally did, and they would blame the contractor, just saying, "Oh, well, you know, we're not used to this type of thing, so this is new to us." The main learnings here were that the standardization of contracts really matter. One issue that the fund had was that they had never seen a lighting as a service contract before, and they had no idea what the best practices were regarding finance. So they did a lot of legal review as if it was the very first time they had seen this type of thing, and they ended up asking the ESCO as well to change the contract that they had with their client, which was troubling. The fund's experience level definitely matters. I would say this especially to ESCOs that are just starting and looking for finance. You need to be prepared. If you're working with a fund that offers something really quickly and everything seems great, you should also, just as they would look to see what your track record is, it's important for you similarly to look at what their track record is. Have they done this before, and are you willing to take a lot of time, or will you lose clients? That's a question that you have to ask. You might not have a choice because, to be honest, there's so much that's new, and so much of this is brand new to everyone. So there is a learning curve. The positive is that the ESCO got the money. They were able to rebuild their pipeline and have successfully rolled out a number of projects since then, and these are really micro-sized projects like with charities and local sports teams. They're really using this as a launching pad for their business and will be looking to find growth capital in their company itself so that they can actually move forward and have more salespeople and start to live off of the profits that they're gaining. So the way forward, what can we conclude from all of this? Did the SEAF project succeed the way we thought it did? Has it closed the financing gap? Have we created the marketplace for sustainable energy assets? I would say yes and no. We've definitely made progress, and we are doing what we can with what we have where we are. We are working very closely with financiers. We are seeing deals go through and being processed. But just as these two cases show, it takes more time than expected. And what we realize is that while markets are different, taxes are different, tariffs are different, issues of finance really are united. Especially most of these funds are looking at investing in numerous different countries, but they don't have the processes yet set up that fit the purpose of smaller SME-sized projects. Most of them are all coming from the habits of very large funds. So there's a lack of contract standardization for EPC contracts. There are many different EPCs. I'm not saying there aren't any. There are many templates that have been developed, you know, in the UK, in Spain, all over the place. Italy, I know, there are standard EPC templates that have been proposed. But none of these have been really practiced and tested by investors. And so they end up always looking at them as if it's the very first time and if it's starting from scratch. So there's still a lot to do in this area to make this fit for purpose for investors. There's also a lack of risk assessment standardization. Both cases really show that the ethical bank, for example, and the fund that was doing forfeiting for the first case had a much different approach to risk and much different areas of risk that concerned them, whereas the second fund had never experienced this type of project, and it was just an entirely new development cycle for them. There's also a lack of growth capital for ESCOs themselves, especially as the second project, the second case study, really demonstrates. ESCOs can only do so much to be able to get things going. And project finance won't serve you if you can't prove that you have a solid business, if you can't prove that you have the salespeople and the marketing capacity to actually move forward with the finance that the financiers are offering. So that's definitely one thing that we saw, and the second case was very fortunate that they now will be able to have a good track record to attract equity capital, but they absolutely weren't able to do that in the beginning. And again, that also shows that there's also oftentimes a lack of developers' robust project pipelines. In order for projects and investors to be able to bite, they usually have a minimum threshold. And so for that, this is really tied to the growth capital and the sales capacity. But in order to get that pipeline going, that then can get the investment, you need to have in general a strong outreach plan and really. Hello.
Hello. Yes, we hear you. So go ahead, Caroline.
Oh, sorry. I heard a strange sound. So to move on, I realize that I'm getting a little bit late on time. Our real conclusions here are that we need to have ESCO standardized certification criteria and standardized EPC contracts, which aren't quite where they should be at the moment. There needs to be a recognition that banks also won't solve this issue for a long time. Banks are very slow. As we can see, funds are moving faster, but they still have a lot of catching up to do. I would say that we really need to look towards independent funds, crowdfunding, and more community engagement. These are critical enablers for the growth of the market. And we're continuing to work closely with these individually in order to support them, build their processes to close that deal, that gap, that time that it takes to close a deal. And we'll also be doing actually another research project very soon, which I'm sure you'll hear about in the coming weeks. So I think that it's really time for questions now. I've gone a bit over time, so please feel free to, we can just wrap up here. I would say you can take a look at the slides on your own if it's of interest. And if you have questions that I'm also unable to answer now, you can contact me right here.